The dollar just buckled in real time. Minutes after Jerome Powell hinted at cutting rates, global markets spun out. Stocks spiked, but the U.S. currency plunged. And the fallout wasn't overseas, it was at home. Your mortgage, your groceries, your savings, all tied to a dollar that's being hollowed out by Washington's own hand. For the first time in decades, America's allies, Europe, Japan, even India, are quietly walking away from treasuries. Trillions are moving into gold and other currencies, leaving the dollar weaker than at any point in a generation. This isn't a forecast. It's already happening. And the reversal Trump demanded may be the very spark that pushes the dollar into a collapse no one thought possible. Because a cut right now is not a fine-tuned adjustment. It is a lurch. Inflation is still above target. Consumer prices in July were 2.7% higher than a year earlier. Core inflation ran at 3.1%. Yet Trump wanted rates down to ease the burden of $37 trillion in federal debt. He berated Powell as too late and demanded relief from mortgages and spending. What the markets heard was not reassurance, but recoil. The United States prepared to weaken its own currency to keep its finances afloat. Investors abroad responded in real time. The New York Fed reported that foreign central banks have pulled roughly $48 billion out of treasuries since March. That really matters because foreigners still hold about $9 trillion of U.S. debt, nearly a third of the market. If they hesitate, someone else must step in. Domestic funds can buy more, but only at higher yields. Higher yields mean the government pays more just to stand still. Debt service has already passed $1.22 trillion a year. Every uptick in rates adds billions more. The premise of the dollar's supremacy has always been stability. Investors accept lower returns because they trust the value will hold. But if Washington signals it is deliberately loosening, that compact breaks. The dollar index is already down nearly 9% this year. Usually, foreign central banks sell treasuries when the dollar is strong, and they need to defend their own currencies. This time, they're selling while the dollar is weak. That is not rebalancing. That is retreat. So where is that money going? Into gold. HSBC reports that Chinese household portfolios doubled their gold allocation in a year, from 7% to 15%. Central banks worldwide bought more than 1,000 tons last year, the highest on record. The price followed. In January, gold traded near $2,600. By August, it crossed $3,400, a 30% rise that outpaced both U.S. stocks and Chinese equities. Analysts at ING noted simply, a weaker dollar remains the most powerful tailwind for bullion. The Fed may intend to rescue the economy, but the move sends capital fleeing from the very asset America relies on. Instead of flowing into factories or payrolls, cheap money flows into buybacks and balance sheets. Bloomberg estimates U.S. companies will repurchase $1.1 trillion of stock this year, led by Apple, Alphabet, and major banks. That inflates share prices without building capacity. If cheaper credit is recycled into corporate self-support, then the policy lifeline boomerangs into proof of stagnation. For households, the recoil is sharper. Yes, a mortgage may drop a few basis points if Powell cuts, but groceries rise faster. Tariffs have driven the effective U.S. rate near 15%. And Powell himself admitted at Jackson Hole, the effects of tariffs on consumer prices are now clearly visible. A softer dollar only magnifies that pain. Families pay more for imports at checkout, while wages barely move. The supposed relief at the bank evaporates in the supermarket aisle. Global reserve managers see the same math. The IMF calculates the dollar now makes up less than 58% of global foreign exchange reserves, the lowest share in nearly 3 decades. At the start of the century, it was over 70%. Each point lost represents hundreds of billions diverted, increasingly into euros, yen, and gold. That decline had been slow. Under current U.S. policy, it is quickening. For those holding reserves, the calculus is simple. Why overweight a currency when its guardians are willing to undermine it? Meanwhile, U.S. corporations are gorging on debt. S&P Global estimates issuance will hit $1.6 trillion this year. Companies want to lock in lower borrowing costs while they can. But here's the problem. The same investors turning away from treasuries are supposed to buy this paper too. Why would they? If Washington's debt no longer feels safe, corporate bonds look riskier still. The cycle threatens to choke itself. More borrowing into less trust. Layer on sanctions, and the system snaps back again. For decades, Washington used dollar dominance as leverage. Every sanction reinforced its reach. But each sanction also gave countries another reason to find workarounds. Today, Russia and China settle more than half their trade in local currencies. India pays for oil in rupees. These arrangements were once symbolic, but now they're stacking up. Each one trims a sliver of demand from the dollar. China's central bank has made its shift plain. Since 2022, it has raised its official gold holdings from about 2,000 to over 2,200 tons. Gold share of its reserves has climbed from 3% to nearly 7%. Each ton purchased is a ton of treasuries not bought, and bullion cannot be frozen or sanctioned by Washington. The White House seemed to recognize the danger when it floated a tariff on gold earlier this year, a 39% levy on imports. Markets read it as panic. Within weeks, the administration dropped the idea and exempted bullion. Instead of reinforcing confidence, the reversal confirmed improvisation. Investors saw a government trying to patch cracks with quick fixes, and the blowback doesn't stop with adversaries. The European Central Bank quietly raised its gold holdings this summer, the highest since the 1990s. France and Germany are expanding settlements in euros for Middle Eastern trade. Japan, once the most reliable buyer of treasuries, sold nearly $15 billion in the second quarter alone, its fastest reduction in more than a decade. India's central bank announced record gold purchases this spring. These are not adversaries dismantling the dollar. They're allies hedging against it. And there's another quiet shift happening in the background. Sovereign wealth funds, some of the largest pools of capital on the planet, are pulling away from the dollar. Norway's trillion-dollar oil fund reported this summer that it trimmed U.S. Treasury exposure for the first time in years, citing currency volatility as a key reason. The Gulf states are making similar moves. The Abu Dhabi Investment Authority has been channeling more assets into Asia, while Qatar's fund increased allocations to Chinese equities. These are long-horizon investors, and when they rebalance away from U.S. paper, it signals a bet on a different future. Commodities tell the same story. Brazil confirmed that nearly half of its soybean exports to China this year have been invoiced in yuan, bypassing the dollar entirely. The same pattern is emerging in energy. Russian oil to India is now almost fully settled in rupees or dirhams. Middle Eastern suppliers are quietly experimenting with euro contracts. These flows add up. Trillions of dollars worth of commodities that once reflexively cleared to the greenback are beginning to fracture into parallel channels. And for Americans at home, the risks are not abstract. Pension funds are some of the largest holders of treasuries. If yields rise to lure foreign buyers back, the value of those existing bonds falls, cutting into retirement portfolios. The same dynamic hits 401k, tied to bond indexes. What looks like a distant geopolitical shift becomes immediate. A weaker dollar and higher yields erode savings at the same time that grocery bills and rents climb. That is how global diversification lands in everyday life. Not as a headline about China or Europe, but as a shrinking balance in an American household account. So the picture sharpens. Foreign central banks are not staging a dramatic walkout. They are drifting away, month after month, transaction by transaction. The dollar still dominates, but the edge is dulling. Washington pays over $1 trillion a year in interest. Powell signals more easing is likely, and the largest holders of treasuries are voting with sales. For decades, the fear was that rivals might build an alternative strong enough to topple the dollar. What 2025 shows is more unsettling. America is eroding its own anchor. Each cut that is supposed to reassure makes investors hesitate. Each tariff meant to protect households raises their costs. Each policy reversal designed to steady the system reveals improvisation. And the sharpest twist is this. The dollar's decline is no longer only about Beijing or Moscow pushing alternatives. It is about Frankfurt, Tokyo, and New Delhi deciding that overexposure is too dangerous. The recoil of U.S. decisions is landing not just on rivals, but on allies who once underwrote the system. That is a fatal mistake. A reserve currency weakened not by an external assault, but by the self-inflicted reversals of the very country that depends on it most.